Okay, everybody. I just started recording, and there's some actually music playing on the line that's never happened before. So I want to know if you guys can hear the music, or I should just be ignoring it. Okay. I think I just found the problem, so I think I've solved that. Hello, everybody. My name is Dave Hirschman of Origination Pro. Welcome to our webinar today, Understanding Rates and the Secondary Markets. First, I'm going to start with an introduction to myself. I've been in the industry over 30 years. Of course, I started when I was 7. I started as a producer, producing 600 transactions my first 18 months in the industry. I closed 60 transactions in my 12th month. I've run sales forces for large production organization, directed the sales force for a technology company, Ellie Mae. I've written 7 books in the areas of finance, sales management, including 2 published by the Mortgage Bankers Association, and hundreds of articles as well. Been director and founder of a federally chartered bank, been a keynote speaker at hundreds of industry events, and currently Senior VP of Sales at Weichert Financial. I want to quickly welcome members of the Origination Pro marketing system and students and their guests. Our goal is to help loan officers become and stay experts and help them market like experts. Experts make more money in every industry. That's why we focus on training and marketing system. Those who are on trial, your trial is good for 14 days and you have access to all materials. Students of our courses get extended free trials. We're not going to spend any time today going over our system, as this is a commercial free presentation, but feel free to ask questions at the end. Our goals today, we're going to cover some updates on rules and legislation, what's going on in the industry. We're going to do a market update. That's really important today since we're talking about rates. Why today's topic is really important. Then we're going to introduce you to 10 important rate and market concepts, and we'll finish with a summary. So let's start with the legislative and market update. Here's some mortgage rules that have changed recently. VA and FHA lowered their maximum cash out percentage for refis. A lot of refis going on today. FHA allows spot approval for condos, which should help more first-time home buyers. These new rules will be effective in October, I believe October 15th. The Fed signed off on a rule not requiring appraisal below $400,000. Before you get excited about that one, it doesn't apply to FHA, VA, Fannie, or Freddie, so it's not going to apply to a lot of the loans done today. And the administration released their government-sponsored enterprise plan, which is the plan to release Fannie and Freddie from conservatorship. Don't expect congressional action quickly, but that doesn't mean the administration may not take individual steps in the meanwhile, waiting for congressional action, if it ever occurs. It's been close to 10 years that Fannie and Freddie have been under government conservatorship. The market update. What's going on today? Well, we had some really important economic reports recently. August jobs data was slightly lower than expected. The second quarter economic growth at 2% was also slower, but that was expected. A lot of people are pointing towards the trade war, which has affected many things. For example, the stock market, we've seen much more volatility. Coal prices have gone higher, and interest rates are lower. And of course, I already mentioned that means a lot of people are refining. Anybody who closed on a deal at the end of last year or the beginning of this year, they should be looking at the possibility of refinancing. The Fed meets next week. The markets are expecting another rate decrease of at least a quarter. That does not mean that mortgage rates will fall. The long-term interest rates often act before the Fed acts, and indeed, long-term rates have already gone down. So the biggest surprise would be if the Fed did nothing, which could cause rates to go up. And actually, in the last day or two, and this is not unusual, when the Fed meeting approaches, we see rates going up ahead of time a little bit. Does not mean that they're going to stay up, but that is a possibility, especially if the Fed does nothing. A lesser surprise, but still a surprise, would be if they lowered rates, short-term rates, by 0.5%. That could cause the market to get a little bit stronger, which means rates will go down. And I'll explain more about that later. Here's one thing that everybody should be keeping their eye on. If we get a trade agreement between the United States and China and things ease up, does that mean that rates will automatically, go up? They could. Here's the point. Never try to predict the future. We're going to say that many, many times. Okay, so those are our updates. Still got people signing in. Welcome. My name is Dave Hirschman. Welcome to our webinar today. This is being recorded. Understanding rates and the markets. First of all, a caveat. This webinar will not help you predict the future. As a matter of fact, it's more likely to make you understand why you cannot predict the future. Another thing I wanted to point out, don't get lost in the terms of this webinar. I am going to state secondary market terms at times. Try to understand the concepts. You're not going to become an expert in the secondary market in an hour. But these are all terms that if you've been in the industry for a long time, you've probably heard time and time again. I just don't want you to get intimidated by the fact that we're going to use secondary jargon as we explain these concepts. Focus on the concepts. Why is this topic important today? Well, we're subject to many cycles in this industry. We have economic cycles, interest rate cycles, seasonal cycles, even monthly cycles. And mortgage rates are a leading factor in determining cycles and what your income will be. For example, did you expect rates to fall in 2019? Well, the experts did not, and by the way, we pay them, hundreds of thousands of dollars a year, to give us the wrong predictions. Here's my point. If they can't predict the future, neither can you. The secondary market, to a great extent, contributed to the financial crisis as well as the preceding real estate boom. We're going to talk about that, here and there. If you want to be an expert in this industry, you must understand the dynamics of interest rates. And you also need to be able to advise your clients regarding the risks of locking in a rate and the risk of floating a rate. Notice I didn't say tell them what to do, because remember, it's their loan, it's their decision. Our job is to educate them. So, without too much further ado, let's move on to the 10 important concepts regarding interest rates and the secondary market. First concept, fairly easy one. What is this secondary market? When a loan officer takes an application from a customer and the lender makes the loan, that is called the primary market, or what we call retail in this industry. You all should be familiar with the term retail. So when you're dealing with a loan officer, you're dealing in the primary market. When a mortgage company makes the loan and then sells it, that is the secondary market, or what we call wholesale. The loan now becomes a commodity. So we have the primary market, or retail, and the secondary market, or wholesale. Now let's talk a little bit about the history of the secondary market. It actually goes back to the Great Depression. And by the way, no, I wasn't alive then, but I think my parents were. The Dust Bowl and there's a little history lesson here, put our agricultural nation in jeopardy. There was also a housing and financial crisis similar to our more recent Great Recession. Through the Depression was born the commodities market. The purpose of this market was to minimize risk for farmers. It gave them the ability to sell commodities in the future, for example, corn or wheat, which is also called hedging, which protected farmers. When you look at it, farming is a very, very risky. You could buy land, spend hundreds of thousands of dollars, plant, and then you could have no crop at the end of the year because of the weather. Or the weather could be good and everybody has a good crop and you can't sell it. Unlike a car, which can sit on the lot for a year, you can't let corn sit around for a year. They have to be able to sell it or not. So what they did is they set up a commodities market, which, by the way, is located in Chicago, not New York, not San Francisco. The commodities market is Chicago because it's close to the farm belt of our nation. Also, the Depression brought us two agencies, which were the first participants in the secondary market for mortgages. FHA was born and Fannie Mae was born out of the Depression. So when I say there's a history, this goes back pretty far, almost 100 years. Now, what are the benefits of the secondary market? You know, loan officers and realtors hear all the time, oh, we can't do this loan. It can't be sold into the secondary market. Or we need to find a place for it where we can park it so we don't have to sell it. Well, here are the benefits of having it, even though there are regulations that you have to adhere to. Selling loans into the future or hedging, again, that word hedging, which we'll come back to, enables consumers to lock in rates from a period of 10 days to 180 days out. Otherwise, their rate would be determined when they settled on the loan. Or another option would be that there would be no fixed rate loans, there would only be adjustable rate loans. So the fact that you can sign a sales contract and lock in a loan for 45 days is because we have a secondary market. Being able to sell loans means that there is a constant supply of mortgages available. If all entities had to hold on to the mortgages that they made, they could run out of money very, very quickly. And by the way, many, many years ago, before the secondary market for mortgages was very developed, and we had a savings and loan dominated industry, there were times when savings and loans ran out of money to lend. This keeps a constant supply. Product development, because if the markets can find buyers for a particular loan product, we can originate. As a matter of fact, product development became too easy during the real estate boom. And remember, that was that boom, the subprime, where people, if they could fog a mirror, they could get a loan. They could fog a mirror, they can get a loan. Um, well, that helped contribute to the real estate boom and also the financial crisis which followed. So, in essence, the secondary market got too efficient in development of products. But still today, where the secondary market is more restrictive, it's important to be able to develop products, and be able to sell them as well. So, second concept, what is a mortgage commodity? Well, you should know what a mortgage is. After it is made, it could be sold, traded like oil or gold or the dollar itself. People buy and sell mortgages and pools of mortgages, and we're not going to get into the specifics of pools and things like that today, but they can be traded just like gold or oil. Mortgages are in a class that are called interest rate denominated instruments. And all that means is they're named by the interest rate they have. So you can have a 4% mortgage you're selling. First thing you'd want to ask about a mortgage if you were to buy it is, what's the interest rate? You don't want to ask a lot of other questions as well. But just like treasury bonds, they're interest rate denominated instruments. So they're based upon interest rates, or they're named after interest rates. Now, the value of these commodities actually go up as rates go down, which is the opposite of what we think in times. A value of a mortgage that's already been made, not today's mortgage that you're going to apply for, but a mortgage that's on the secondary market that somebody owns, will go up or down depending upon the direction of interest rate. A 4% mortgage goes up in value when rates fall and down in value when rates go up. Or another way of saying that is, when the bond market is up, that means rates are falling. Now, why is that the case? Well, let's say you bought a 4% mortgage. You own that mortgage. And rates go to 5%. Well, why would somebody else purchase that mortgage from you if they could earn 5% elsewhere by buying a mortgage at 5%? So if rates go up, the value of your mortgage goes down. Conversely, if rates go down, the value of your mortgage goes up. Here's what the value of a mortgage looks like when you sell them. And by the way, this is an oversimplification. I use even numbers just so it's less confusing. You may look on a rate sheet today, or even on a secondary market pricing, and you may see a mortgage at 4.5%, which is 101. We call that over par, which means the consumer gets a 1-point credit towards closing costs. We call that credit a YSP, or a yield spread premium. And yield spread premiums makes no closing cost loans and no point loans possible. At 4.25, they can choose par, which means the consumer pays no points. Or at 4%, they can choose 99, which is under par, which means the consumer pays a point. So if a consumer wants to get a lower rate, they can pay points to get a lower rate. We call that discount points. We call that discount points. Or if they want to pay less closing costs, they can opt for a higher rate. They can opt for a higher rate. Fourth concept, what is a hedge? A hedge is a form of protection. A hedge around your house protects your house visually. The secondary market enables a lender to sell a loan into the futures market to reduce the risk of losses that occur between the time that it's locked with the consumer and it closes and can be delivered to an investor after it closes. That's the same protection the farmers get, obviously for a different commodity. If a lender has a pipeline of loans and they're not hedged or locked in the future, the risk is great. Let's put it this way, $100 million unprotected pipeline and a 2-point move in the markets, which, by the way, I've seen happen in a day, is a $2 million cash loss if it moves in the wrong direction. So that's too much of a risk for lenders to take. If this were the case, if there was no hedging, you would only see big banks in the mortgage business because their portfolio would be the only way to make them. And by the way, again, most of the loans would be adjustable rate mortgages. So hedging is important. That is another word for hedge is protection. We're protecting the lender, which enables them to protect the consumer by offering a lock. Now, I keep talking about the futures market. Let's look at what the future looks like. Let's say today's June 1st, and we look at delivery dates of a mortgage. Now, a delivery date would happen after a loan is closed. So let's say the loan closed in June 10th, but you can deliver it in June. The price would be 100.5. That's above par, which is a half a point credit. July is 100, which is par. August is 99.75, which is under par. They're paying a quarter a point. If we looked at the bottom of the page, what you see, what the borrower gets quoted is a 10-day price with a quarter point credit, or a 30-day price of par, or a 60-day price of a quarter of a point where the borrower pays a quarter of a point. So the further you go out in the future, the more risk the lender and the markets are assuming. So typically it costs more. I say typically because spreads change, and we're going to come back to spreads later on. So assuming no add-ons, again, an oversimplification, this is what the future would look like. The consumer sees a quote of 10 days, 30 days, maybe 45 days, maybe 60 days. And it's basically the futures market that is determining these prices. It is not the lender determining these prices. Number 5, let's talk about interest rates themselves. We talk about how important interest rates are, but what determines interest rates? I'm going to introduce you to three different risks, because interest rates are all about risk. And by the way, I want to remind people, and I'm just that you can ask questions. I know some of this information may be, for some people it may be just review. Other people it may be brand new, and you're learning it for the first time. Don't hesitate to ask questions using the panel on your screen. We can answer them at the end of the webinar. Okay, risk number 1, and probably the most important risk, is inflation. Why is inflation so important? Well, inflation makes money worth less. And what we're doing here is we're lending money. So, for example, if you had $100,000 and you lent it to somebody and there was a 10% inflation rate, that money would only buy $90,000 worth of goods in a year. So, in essence, you would have to charge 10% interest just to break even. In essence, the inflation rate becomes the base for interest rates, because I don't know any bank that wants to break even, right? So if the inflation rate is 2%, which is about where it is today, we would say that that's the base of interest rate, but it doesn't mean rates are going to move to 2%. It means there needs to be some sort of profit margin above that. Now, point number one, you can't predict the future of inflation. That's why bond trading is just as risky as trading stocks. It's why we can't predict the future of interest rates. And it's also why long-term rates are usually higher than short-term rates, what we call a positive yield spread. So usually, you know this, 30-year fixed rates are usually higher than 15-year fixed rates, because if somebody's going to lend further out into the future, they're taking more inflationary risk, which translates into interest rate risk. Now, a question you might ask is, are long-term rates always higher? Well, we explained a positive yield spread, which is normal. That means long-term rates are higher than short-term rates. What happens when we have an inverted yield spread, which means short-term rates are higher? Well, that happens when we either have a very high inflation rate, where people are expecting inflation to come down, or there's some sort of other turn in the market. For example, today, many are expecting an economic slowdown. When I did my market update for you guys earlier, you saw evidence of that, because the economy only grew at a 2% rate. Last year, it grew at a greater rate. So many are expecting an economic slowdown, and a lot are expecting a recession. Thus, long-term rates, including mortgage rates, have come down. But the Fed Reserve, who controls short-term rates, we'll talk about the Fed in a moment, basically has not brought down short-term rates as much as long-term rates. So what you see in this chart is the spread between the 2-year and the 10-year Treasury note. Usually there's a big spread, 2.5%, but look, the spread is now close to zero. Zero means a flat yield curve, and less than zero is an inverted yield curve. And that doesn't mean that 15-year rates are going to be higher than 30-year rates. We're just talking about Treasury bonds here. Sorry, I got an itchy trigger finger on my wheel here. So let's go to the Fed themselves. Who is the Fed? The Fed is an independent entity. It serves, even though the members are appointed by the president, they serve independent of the president and Congress. And their major goal is to lessen the risk of inflation. And now you know why it's so important, because if inflation is lower, rates will be lower as well. Inflation risk explains why the Fed can raise short-term rates and mortgage rates can go down, because the market perceives the Fed will be bringing inflation down by raising their rates, and therefore bonds react positively when they go up in price. The Fed controls instruments such as the discount rate and also the federal funds rate, and those are very short-term funds. How short-term? Well, It's basically the rate they charge banks to borrow money overnight to balance their uh, balance sheets, because they have to balance their sheets every day. Banks do. I know that because I was on the board of a bank. Therefore, the Fed affects short-term rates directly and long-term rates indirectly. If the Fed lowers rates by 0.5%, the markets may interpret that as saying the Fed thinks that a recession might be coming. Then rates might go down even a little bit more. Though we're not expecting necessarily a 0.5 point. We're expecting 1/4 point, but it could happen. One caveat on that, and this happened during the recovery from the recession. When the Fed goes out and purchases treasuries and mortgages in the open markets, they can directly affect the long-term markets as well. So they can affect long-term rates as well. Two more risks that affect rates. Second is the risk of prepayment. When a loan if you lend money and the loan gets paid back, that's a good thing. That's good news. But when you're an investor, it's only good news compared to a default, which means you don't get paid back. Because when the loan's prepaid, an investor now must reinvest the money at today's rates. So what's happening in today's market is rates are going down. People that own mortgages are seeing their loans prepay, and now they're having to reinvest at lower rates today. So what we call that is the risk of prepayment. There's a risk for lenders when rates go up of them taking losses. There's also a risk of prepayment for investors as well. And that is happening in the markets right now today by people refinancing. And I'm going to come back to that in a minute. Third, the risk of default, which is something we're all familiar with. I shouldn't have to explain it much. This is why a B credit loan costs more than an A credit loan. Loan level pricing adjustments due to low credit scores are an indicator of this issue. Somebody has a low credit score, they're more likely to default, therefore they're going to be charged a higher interest rate. Another thing that happened during the real estate boom was the secondary market got so crazy that they weren't, the spread between A credit and B credit got ridiculously small, which means they weren't pricing for risk. And boy, they got hit with it, because when the financial crisis hit, they found out what the risk of default was. Whole banks, whole mortgage companies went out of business, and large entities as well. So here's another thing to ask. What happened to all these no closing cost loans we had? In the past, we could opt for an interest rate and pay no closing costs. So I showed an example of getting 1 point credit. But what about getting 3 or 4 point credits? Today, higher rates are not typically providing enough credit to pay all closing costs. I've got a little typo in there. Got a few typos I'll probably get with. The national online lenders have become so efficient in refinancing clients, secondary market premiums, above par premiums, are disappearing. Think about it. If someone purchases a loan at a higher rate, I buy a loan, not at today's 3.5% or 3.75% or 4%, but I buy it at 5%, and I give somebody a chunk of money for closing costs up front. Well, I expect to earn that money back over time with the extra interest. But if the loan refinances too quickly, I just lost my money. That is the quintessential definition of the risk of prepayment. So loans are prepaying so quickly because lenders have gotten so efficient at refinancing that no closing cost loans have basically gone away. You can get some credit, but not as much credit as it used to have. Okay, just a little pause here. We're about 3/4 of the way through, and I just wanted to give, I think we have just a few more topics, or quick ones. But remember, if you've got a question, use your panel to ask it. Hopefully I haven't put everybody to sleep or people don't understand. So even if you have a comment about something, go ahead and throw it in there. So let's add a few more concepts: spreads, servicing, and warehouse lines. Number 6, you must understand the spreads. And I'm not talking about cream cheese here. Spreads are essential to understanding rates. We already went through an example of the spread between the 2-year and the 10-year or 20-year Treasury bond. Those have narrowed when we have a flat yield curve. But there's also a lot of other spreads. The spread between jumbo and conforming loans, the spread between long and short-term rates, the spread between mortgages and other financial instruments, between 30-year loans and 15-year loans, between 15-day and 60-day pricing, between A credit and B credit. We've already mentioned a bunch of these, but I'm just going to point one of them out today. The 10-year treasuries, which mortgages tend to follow, because mortgages don't last for 30 years. They last a lot quicker because of refinancing and people moving. So an average mortgage might be 5 to 7 years, depending upon where interest rates are. At the same time, that's closer to a 10-year treasury. Though I would argue that it's shortened up in the last couple of years because of the efficiency of refinancing. But note the spread has changed. This shows the spread between a treasuries and a 30-year fixed loan over time. If you see the yellow, look how narrow that is next to the yellow. And if you look at the very end at 2018, you're going to see a bit wider spread. And it's actually gotten wider since this chart was done. What's happened in the last 2 months is 10-year treasuries have dropped and mortgage rates have gone down, but not as much as 10-year treasuries. So the spread has gotten wider. So when you hear the radio say, hey, rates have gone down, treasuries have gone down, yeah, mortgage rates probably will go down, but they don't necessarily move at the same pace. The spreads can change. Concept number 7, the second commodity, servicing. I indicated previously that we create a commodity when we make a mortgage. And in truth, it's really 2 commodities. It's the loan itself and the right to service the loan. The servicing is a separate commodity that affects the rate on the loan. That affects the rate on the loan. So when your lender says, hey, your loan is sold, it actually means the servicing's transferred, because the consumer, when they buy a house, they only notice that the loan is sold if the payment is going to someone different. So if they make their first payment to a lender, and then now they have to make the payment to another lender, it could mean the loan is sold, but it definitely means the servicing was transferred. And keep in mind, we talked about interest rate risks. Well, interest rates also affect servicing risk. During an economic slump, the value of service went down because of the high level of defaults. Also, when rates fall, the risk of prepayment goes up. Why would servicing have value? Well, let's talk about what a servicer does. I'm going to do this very quickly. They collect payments. They set up escrows. They pay escrows when they're due. They send principal to the owner of the mortgage. They send out reports. They send forms to the IRS. They give out payment information, customer service, escrow analysis, collections. And if that doesn't work, foreclosure and more. And my question to you, would you service a loan for the approximately $750 a servicer gets in a year to service it? The answer is the cost, of course not. So how could there be a value in servicing? Well, originations is a labor-intensive business. Okay, servicing is a technology-based business. It's more conducive to volume. One $300,000 loan, approximately $750 in servicing revenue. But let's skip down to $1 million loans, and that's $750 annual. Anything less than several thousand loans is too small for a servicer to be profitable. In addition to this servicing revenue, of major importance, the servicer is in the home of the client every month. They get a long-term relationship. They get a notice from their servicer every month. They can sell them other things. If it's a bank, they can sell them credit cards, car loans. This is added value that cannot be measured. I'm sure somebody's measured it. Why is servicing value important? Well, what affects the value of servicing affects the value of the loan. For example, smaller loans are more expensive to service than bigger loans. Just like a realtor sells a bigger home, they get more commission. Same thing for an originator, same thing for a servicer. So you may see price level adjustments for smaller loan sizes. Partially, that's because of the servicing value. There's less servicing value. Even escrows, even the difference between FHA and VA loans, when there is a difference, is because VA loans are 25% guaranteed. FHA loans are 100% insured. So there's slightly more risk when a lender does a VA loan. However, VA loans tend to default more, so that sometimes evens out in the market. The only point to remember here is the servicing value can affect the rate on a rate sheet. And that is obviously important. Okay, we're getting some comments in. Good. And questions. Number 8, your lender does not have money to lend. Believe it or not, if a lender does $1 billion in fundings a year, that doesn't mean they have $1 billion in the bank. They borrow the money. It's called the warehouse line, which is the line of credit secured by closing instruments. Short-term lender, the lender pays interest on this warehouse line, and the loan's sold quickly. A lot of times within 30 days, might be 10, 15 days, they are sold. The lender keeps the interest that are paid on the loan until it's sold, and they have to pay interest on the line. So if the lender collects 5% from the consumer and the warehouse line cost is 4%, there's called the positive warehouse spread, which becomes a profit center. But in an era where there's an inverted yield spread, there may be a loss on the warehouse lines. The financial crisis affected the availability of warehouse lines, which means that some companies had to close just because they could not get lines. And by the way, when the loan's sold, the money goes back to pay off the warehouse line. That's why it's called the warehouse line. It's sort of like we're holding loans, we're warehousing them. We sell them, then we put the money back. So 9 and 10 are very quick. What do you say when your consumer asks or the realtor asks where our rates are headed? Here's what I teach loan officers to say. No one knows where rates will go. The economists are paid hundreds of thousands per year to analyze the markets, and they can't tell. My job is to keep you on top of the markets in order to give you quality information so you can make the best educated decision. I always like to cite the Ben Bernanke example. He's a former head of the Federal Reserve, lived in the DC area, as they would, and he refinanced one year. And he wound up refinancing again the next year because rates came down again. Well, if the head of the Federal Reserve does not know where rates are going to go, that's a great example. Here's a secondary thing you can say. My job is also to educate you on what the real cost and benefit of rate movements after taxes. What is the cost or benefit if rates move an 8% in one direction or another on a monthly after-tax basis? Number 10, rates going up. The consumer thinks when rates go up, lenders make more money on that. Well, lenders do not make more money when rates rise, even though consumers think so. A typical profit for a lender all in, and there's never a typical year, unfortunately, might be 25 basis points or a quarter of a point. Profit on a loan, believe it or not. And when rates go up, typically business goes down and therefore profits go down. So lenders hate it when rates go up, even more than consumers. Think about that. But the typical consumer thinks if rates are going up, somebody's making more money. Maybe the owner of the loan in the long run. But anyway, here we are. We went over the 10 important concepts, why this topic is important, the market update, rules and legislative update. Hopefully you guys learned something today. I do have a couple of comments in here and questions. I want to go over them, but we finished right on time. It was 50 minutes. I always allow 10 minutes for questions. Okay, see what we've got here. Why, when a consumer locks and rates drop, do banks not want to honor the lower rate? Great question. Because, and I didn't get into this because it is a little bit more complex. There are two types of hedges, an optional hedge and a mandatory hedge. Typically, lenders, because it's cheaper, optionals would cost a lot more. A mandatory hedge, even though rates drop, the lender still has to deliver the loan, even if the consumer walks. So basically, if the consumer walks, they take a loss. They pay to hedge that. They have to deliver a loan. They actually have to go into the markets, buy another loan, and pair it off with the loan that they were supposed to have to deliver. So it's because commitments on the market are mandatory. Now, lenders do use optional commitments, more like in builder lending. You will note if you lock in with the lender for a builder loan, and that's 6 months out, they may collect a point from you up front. That is to fund the cost of that optional commitment. You can see if we gave everybody optional commitments, and it would be much more expensive for the consumer. So on one hand, we're trying to give the lowest rate possible. On the other hand, we obviously need to protect ourselves. And I know that's probably too short an answer to it, but Lisa, that's a great question. Absolutely great question. I've seen recently where lenders are pricing a lower rate loan better than a higher rate loan. Let me see, I'm trying to scroll down to the bottom. Better than a higher rate, meaning more credit given on a lower rate. Why? I'm assuming this is because of the risk in the prepayment. I think that would be unusual, but yet the markets have been getting pretty crazy because of the amount of prepayment. So you're absolutely right. This is Randy who's asked this. You're absolutely right. It is the risk of prepayment that has really gotten to us. what does it cost the servicer to get the rights from a lender to service? What you're asking me, I think, Randy, is what does it cost to buy servicing? It really depends upon the type of loan. Again, different loans are different. It may cost uh, the value of an adjustable rate mortgage, which is really small, maybe zero. The value of a conforming loan might be 30-year fixed loan, I'm sorry, could be maybe 3/4 of a point. The value of a government loan, because Ginnie Mae has a higher BP on their servicing, typically would be a little bit higher. In the long run, I've seen government servicing go for as much as 2 points. In today's market, not so much because of, again, the risk of prepayment. See, what really happens is, let's say the servicing spread is 25 basis points. 25 basis points goes to the servicer every month. So when a lender makes a 4.5 loan, the investor buys on a 4.25 loan with a 1/4 point going to servicing. That's how the economic works. Again, a total oversimplification. A total oversimplification. I love this question. Love this question. Um, this is from Joseph. How is a lender only making 25 basis points on a loan when they pay their branch manager, much more than that? I'm not even going to say how much you put in there. And that's right, believe it or not, because loans are so labor intensive, we pay higher routing commission than the lender actually makes in profit. And that's true in the real estate industry too. You may think, realtors get, 3%, split on their, it's not like the real estate companies making that much either. If you put it in basis points, my guess is real estate companies are that thin as well. This is from Joseph. Can we or I discuss with you something offline as well? Absolutely, Joseph. Origination, my email address or the company's email address is success@originationpro.com. So you see originationpro.com there, just add the word success there, success@originationpro.com. Um, So I think I got most of the comments and questions. We had some great questions there. Great questions, great participation. I hope, and by the way, I got some nice notes from people on the webinar itself. Thank you for those nice notes as well. I don't read them out loud, but I do read them, and it makes me feel like I hit the mark from you guys. And even if you have something, I should have covered or I covered too much, I'd love to see your feedback. Again, you can do it using the panel or success@originationpro.com. I'm stopping the